With that red-hot market, or at least what has been certainly a very nice move in the market. You can see even over the last week, a little less than 3%. 71% of the S&P, by the way, has hit 20-day highs. That's just in the last week. That's only happened 6 times since 1957.
Whoa.
That was even before I was born.
Wow, a long time ago.
Imagine that.
That's why it's red hot.
Renaissance Macro Chairman and CEO Jeff deGraaf joins us. He's here to discuss, as we always ask, Jeff, can the rally keep going? So what do you think?
Well, that stat's an important stat. If we look at that, David, historically, I mean, those times that it's happened, right, the 6 other times it's happened since 1957, out of that, the annualized, the 6-month return out the next 6 months was up 14%. So that annualizes a little better than 28%. You might get a pullback, you might get a pause, but again, as Sarah said, the burden of proof is absolutely on the bears here, and history, internal momentum, which is really important, has really confirmed, and we think, and we wrote a note late last week that it implies escape velocity for the S&P. That was happening while we were in an uptrend, so that's good news. I do think that this has been yield dependent, but that still looks to us to be good news as well with the banks and the REITs and the like. So I think there's more to go here.
Yeah, you're really positive. I mean, what would give you any concern then, if there is any to be had?
Well, I mean, look, the move in real yields, which took us from about 250 basis points in real yields, right? So that's the difference between inflation and nominal. That's been significant, from 250 down to somewhere around 160, 165, and that's driven a lot of what we've seen in equities, and rightfully so. That should happen. If that's wrong, if that's just a mistake or miscalculation on the market's part, then that would be a problem. I don't think that's a high probability event. When we look at the history of real yields above 250, that tends to be fairly restrictive. So once you get there, it's not that you gravitate or linger there. So I think that's good news. But there's no doubt that if you're going to tell me that 10-year yields are going back to 5%, we're going to have a problem with our equity call. But the thing that's encouraging about those 20-day highs is it really implies breadth, right? It's not about the Magnificent Seven. It's actually about everything else, the other 493 stocks. And so when you get that, that's good news for small cap. That's good news for micro cap. That's good news for risk assets. And, I would say tactically, maybe something to be concerned about. I don't think it's right here. That might happen in February, is a little bit of this animal spirit nature coming back in. Maybe it gets a little frothy, but, right here, I think that's still more the outlier than it is the base case.
But do we need bond yields to keep falling for the equity market to keep rallying?
Not really, Sarah. It's a great question. The work that we've done shows that really the yields above about 225, real yields, I should say, 225 to 250 start to really work against equities. Once you're below those levels, you actually have pretty good returns. The further you drop below those levels, the better the return. So obviously there's something there. But I think as long as we stay below 450 for the most part on the nominal 10-year yield, I think we're in pretty good shape. If we can drop this to 350, that might be a long putt, admittedly, but if we drop it to 350, that's very good news for the equity markets. I think if we're stable somewhere around or slightly below 4%, I think that's good news, because now the earnings story will start to kick in. Now the confidence story will come back, and all those things are likely to play for the equity markets in the next 6 months.